Are you surprised, Tim, at just how reactionary this market appears to be to these trade headlines?
I would say not totally surprised that as a deal gets hammered out, you are going to see a little increase in volatility. But I think the backdrop has still been so good year to date for markets, both here in the U.S. and also in China, that it's hard to get too pessimistic even with a few days of volatility, as it seems like this deal gets closer to completion.
As a strategist, do you change your recommendations to clients based on what happens in D.C. this week?
In a word, not a big change. But I think tweaks around the edges can make sense as we look at some of the pillars of the market this year that have really propelled gains.
What are those tweaks?
I think the key tweak would be to say, look, where are some of the lower valuation, better entry point opportunities? And even though you are seeing some volatility in places like China or emerging market stocks, that to us still looks like a more attractive destination, especially as you get to these later stages where there could be actually some upside here if you do get better than expected news on the trade front.
So I have a genius follow-up for you. You ready?
Ready.
Where are those lower valuation, better entry point parts of the market that you just referenced? What are they?
So for the most part, when we're looking at equities, we think emerging market equities. So if you're looking at the price to earnings ratio on something like the MSCI Emerging Markets Index, that's at a significant discount relative to here in the U.S. Now, again, valuations here are not as stretched as they were last year. We did see a nice earnings growth and resetting in price action, bringing the U.S. more in long-term average line with their valuation long-term historical averages. But I think when we look outside of the U.S., particularly international developed, so I think Europe and Japan, but also on the emerging market side, there's still some good opportunities for us as we're looking for reallocation or trying to play this trade deal and what happens.
Now, on every major metric, Japan is the cheapest developed market in the world. Price to earnings, price to sales, price to book, you name it, we can make the case for it being just incredibly inexpensive.
Sure.
But yet the market has done nothing. How come nobody's reacting more to Japan?
Well, I think when you look at some of the structural forces weighing on Japan long term, the story isn't so bright, whether it's demographics, whether it's more restrictive labor market. And so when we're thinking about Japan, I think it's more about a selectivity story. And again, as the U.S. continues to grow and continues to prosper, that's going to naturally be a nice catalyst or a buoy for international developed markets.
And you think that Europe, despite all of its woes, Brexit, and of course Germany, are they slowing down? All this stuff, Europe is a good bet.
Well, when we look at...
Or a better bet than us.
Yeah, well, I think exactly. When you look at year to date, for instance, Europe has lagged, both versus the United States and the rest of the world, but they're still up close to 15% on, again, MSCI Europe index. And so when we're thinking about, from an index standpoint, there's still some great opportunities there. And again, better entry points, lower valuations, you've just seen less of a run up there. So I think when we're positioning ourselves or trying to play this trade deal in Washington, that's where we're looking for opportunities, given that we think there's upside.
Look a little Japan, look a little bit of Europe, maybe tweak around the edges.